Hello and welcome to the Financial Clear, the show where we break down the big economic questions that affect your daily life. I'm your host, and today we're tackling a huge one, the US dollar. Great to be here. So let's just jump right in. Why does the dollar feel like a roller coaster? It seems to spike one day, then it drops sharply the next. And for most of us, this isn't just some abstract number on a screen. You've probably looked at your grocery bill or the price of gasoline and wondered, what is going on?
That's exactly right. These movements aren't just for economists on Wall Street to worry about. Understanding why the dollar rises or falls is genuinely a key piece of knowledge for anyone who wants to protect their wealth and make smart financial decisions.
I'm glad you said that because it can feel really intimidating. It seems so complex. What causes such a powerful, globally dominant currency to fluctuate so much?
It is complex, but it's not a mystery. The dollar's value is the product of a few key interactions, both inside the US and on the global stage. And I find it's easiest to break it down into five main drivers.
Okay, five drivers. I think we can handle that. What's on the list?
We're going to look at inflation, which is the big one everyone's feeling right now. Then the decisions made by the Federal Reserve or the Fed. After that, we'll talk about just general economic confidence and international trade. And finally, the big one, global crises and geopolitics.
Okay, that sounds like a perfect roadmap. Let's start with number one, inflation. This is the one I think everyone feels in their wallet.
Absolutely. The article you and I were looking at earlier had a perfect metaphor for this. Inflation acts like an invisible thief. It doesn't break down your door and steal the cash from your wallet.
It just reduces what you can buy with that cash.
Exactly. When inflation in the US goes up, the dollar's real value, its purchasing power, goes down. If you look back at the 1970s, the US had this awful period of stagflation. That's high inflation and low growth. The dollar lost a ton of strength, and you saw investors just flee to hard assets, things like gold.
So high inflation in the US is bad for the dollar's value. That seems straightforward.
It is, and it's not just a domestic problem. It also changes how the world sees the currency. If US prices are rising too fast, other countries might stop seeing the dollar as that stable, safe place to park their money, which can cause global demand for it to drop.
Okay, so if inflation is the sickness, that brings us to the doctor, right? Which would be the Federal Reserve.
That's a great way to put it. The Fed, which is the US central bank, holds an enormous amount of power over the dollar's destiny.
I feel like all we hear about is the Fed. The Fed is meeting. What will the Fed do? How do they actually control the dollar?
The main tool in their toolkit is setting interest rates. And the general rule is pretty simple. When the Fed raises interest rates, the dollar tends to get stronger.
Okay, hold on. That's the part I think a lot of us miss. Why? Why does a rate decision in Washington make the dollar stronger against, say, the euro or the yen?
It all comes down to chasing profitability. International investors think massive pension funds, banks, or even wealthy individuals are always looking for the best return on their money. If the US starts offering higher interest rates on its bonds, it's like a giant flashing sign that says, better returns here.
So global money just flows into the US.
Precisely. More foreign capital flows into the country to chase those higher returns. But to buy those US assets, what do they need?
US dollars.
They need US dollars. And that increased demand for dollars automatically pushes the dollar's value up. The analogy I love is to think of the US as a restaurant. If you suddenly start offering a higher quality meal for the same price or a big discount, you're going to attract more customers. When the US offers high interest rates, it's attracting more global investors.
That makes perfect sense, and we just saw this happen, right?
A perfect textbook example. In 2022, the Fed aggressively hiked interest rates to fight that soaring inflation we just talked about. And what happened? The dollar strengthened significantly against almost every other major currency. So if you want to anticipate where the dollar is going, you have to watch the Fed. Their announcements are like lighthouses for the currency's path.
Okay, so we have inflation as the thief and the Fed as the doctor, raising rates. What's the third factor? You said economic growth and confidence.
Right. This one is a little softer, but just as important. The dollar is more than just money. It's really a reflection of global confidence in the health of the U.S. economy.
What does that look like in practice?
It means when the U.S. economy looks strong, when its GDP is growing, unemployment is low, and it's innovating, investors want to be there. They feel safe parking their capital in the U.S. That confidence creates a greater demand for dollars.
Can you give me an example of that?
A fascinating one is what happened right after the 2008 financial crisis. Now, think about that. The crisis started in the U.S., it was a severe domestic problem.
You'd think the dollar would have collapsed.
You'd think, but it remained relatively strong. Why? Because compared to a fractured Europe or other volatile emerging economies, the world still viewed the U.S. as the least risky option.
That's incredible. So even in its own crisis, it was still seen as the best bet.
That's the power of confidence. The analogy here is perfect. During a severe storm, everyone in the neighborhood seeks refuge in the most solid house. In global markets, that house is almost always the United States. And that's why the dollar so often appreciates during times of uncertainty.
That's a great segue because I want to ask you about that safe house idea as it relates to international trade. This is factor number 4.
It is.
I always hear that the U.S. has a massive trade deficit, meaning it imports way more stuff, cars, electronics, clothes, than it exports.
Yep.
My high school economics class told me that if you import more than you export, your currency should get weaker. But that's not what happens with the dollar, is it?
You're 100% correct in your textbook logic, but the dollar is different. It remains strong despite that trade deficit for one simple reason. The world requires it.
What do you mean it requires it?
The dollar is the dominant currency for international trade. It's what countries hold in their central banks as their global reserves. If Brazil wants to buy oil from Saudi Arabia, how do they pay for it?
In dollars.
In dollars. Here's a great example. Picture a local community where for some reason everyone uses tokens from one specific casino for all their transactions. Even if that casino buys more goods from the community than it sells, everyone still needs those specific tokens just to participate in the local economy.
So the U.S. is the casino, and we all have to use its tokens to play.
That's a simple way to see it. Yes, the dollar's role as the world's currency creates this constant structural demand for it, which helps keep it strong, even with a trade deficit.
This is fascinating. It feels like all these factors lead to your fifth point, geopolitics and global crises. You said the dollar is the solid house in the storm.
It is. The dollar is the ultimate safe haven asset. This means that in times of extreme crisis, think of wars, pandemics, or sharp instability in other countries, the dollar typically rises.
Even if the crisis has nothing to do with the U.S.
Especially then. Look at the start of the 2020 pandemic. Stock markets were plummeting, supply chains were freezing, and nobody knew what was going to happen next. What did the dollar do?
It got stronger.
It got stronger, at least temporarily. In that moment of pure panic, investors didn't care about risk. They cared about security and liquidity. They wanted the most reliable asset available. And what did they all flock to?
Dollars.
Dollars. Even in the midst of chaos, the dollar tends to be the lifesaver that investors all over the world cling to. It just underscores its incredible role in the world.
Okay, so let's try to wrap this all up. We've got these 5 huge factors: inflation, the Fed's interest rates, general economic confidence, the unique role in trade, and its safe haven status in a crisis.
That's the list, and you can see how they all interact. The dollar is so much more than just a piece of paper. It's really a thermometer that measures the health and the confidence of the entire global economy.
So in summary, the dollar will rise when
The dollar will tend to rise when the Fed raises interest rates, when there is strong confidence in the U.S. economy, and during global crises when people are searching for security.
and it will fall.
It will tend to fall or weaken if excessive inflation in the U.S. eats away at its purchasing power, or if other major economies and their currencies suddenly look much more attractive.
This has been incredibly helpful. I feel like the next time I hear on the news that the dollar appreciated, I won't just see it as this cold, abstract number.
You shouldn't. You should see it as the direct reflection of all these political, economic, and social decisions that are profoundly impacting your daily life.
Before I let you go, I want to hit a few quick questions that I know our listeners are thinking. These are the ones we all have. First, you mentioned people outside the U.S. Why should someone in, say, Peru or Argentina care so much about the dollar?
Oh, for them, it's not academic, it's critical. The dollar's movement directly affects the price of all the imported goods they buy. It affects the value of their country's external debt. And most importantly, it affects the real value of their own savings if they're holding them in their local currency. In many Latin American economies, the dollar's movement is a matter of national financial stability.
What about the flip side? What happens if the dollar gets too weak? Is that just bad?
Not for everyone. A weak dollar is actually fantastic for U.S. exporters. It makes their goods, their cars, their software, their crops suddenly cheaper and more competitive to sell abroad.
But
But